Well, I think this is only our third podcast in this room because most of the time we're doing the virtual and we do it in do it in the other room and stuff. But excited to be able to share this podcast. Right, we have Jerry. And Jerry has been a part of a ton of offerings over the years and a ton of growing businesses and building businesses and one of the really industry founders of the Regulation A industry, an expert. And so I'm going to ask him a ton of questions today. Jerry has not been compensated. I've not been compensated for as we talk about our offering circulars. We're not really offering our securities during this podcast today. But if you guys go and check out GolfSuites or you go check out one of the other offerings that Jerry and his team have or one of our offerings, obviously you need to read the full offering circular, do your due diligence, take your time, do your homework, do everything the right way, right? We're not financial advisors, not lawyers, not CPAs, and I'm not a scuba instructor either. So, let's get started. Tell everybody a little bit about, your landscape, Jerry, your business. You've done a lot, right, in your lifetime, and you have a lot more to do. So tell everybody a little bit so they can kind of get a feel for you, because this is really our tribe's second introduction to you after sharing with our tribe at the summit that we had.
Yeah, well, thanks for having me, Dutch. And by the way, that summit was great. That was very, it encouraged me to write a nice testimonial that I hope you saw.
I did. I appreciate it.
I go back, I'm kind of used to being the oldest in the crowd. I go way back in this. I'm a California licensed CPA, Bay Area native.
So I'm not a CPA, but Jerry is a former CPA.
Licensed but inactive. Licensed but recovered CPA, right? I got into real estate syndication in the early 80s and, just ended up waking up at the end of the 90s with the largest mobile home park chain in the country. I was collecting rent from 26,000 families. We did a big sell-off to the Sam Zell organization in Chicago. I still have ownership in 6 or 7 of the properties that are left, and took some time off, got involved in a high-tech IPO, and put a big hotel company together that then ran into the 2008 financial debacle. And that was a tough blow, but we got through that. Everybody's fine. Sold off our land. Went into home building business, fix and flip, new home construction, did a couple hundred homes around Tampa Bay here from 2011 to about 18, and then took another gap and decided to get back into something a little more substance. We saw, and so because of that, I now chair these two companies, GolfSuites and ERC Communities, pretty much at the core of the same ownership group. It's the same family of owners that we seed capital, both under Reg A, and we do Reg D 506B at the same time, and very diverse companies. GolfSuites, a very sexy retail component, sports entertainment, and ERC is a back to my manufactured home background, is a manufactured home rental scenario where we're not selling the homes, we're renting them. And we have broken ground on 265 units about 30 miles out of Tampa here. So those are our two companies. And, they lean heavily on my background and background of some very capable partners. And, that's what we're doing. I don't want to pitch my products too much here. So
no, but I think it shows, like, what you're doing shows experience. It shows background. It shows history. And because what really our podcast is all about, what we share with our investors is like, what's smart? What are best practices? What are tickets? What are tips and tricks, right? And so obviously you've been a real estate investor a long time, and if you think back to the beginning, that's always a great question, like the early days of real estate investing for you, right? What would you say to the newbie investor, or even investor who's bought 2 or 3 homes, right, and is wanting to really do more investing and stuff? What are some of the pieces of advice you would give? What are the things you think people screw up all the time? Might be a better question.
Wow. There's a lot of opinion there in an answer like this, a lot of bias. When I gave my talk, my breakout talk at your seminar last month, I talked about breaking down finance from economics. And Dutch, I'm sure you'll agree with me, investing is a very personal thing.
Yeah.
It's not a business thing. It's a personal thing. And I talked to this crowd of 30 or 40 people, said, economics, which we don't think about too much, economics is very personal stuff. It's how humans interact. Finance is how money acts. And I have always gone for a contrarian perspective. I've always gone for as much of a recession-proof concept as I can. I notice you're doing that with your farming communities now. That's very contrarian, very protective. It seems
Explain
to me
to everybody what contrarian means.
It just contrary to traditional thinking. I think RADD's move into farming is a perfect example of this. It's like, where did that come from? Your platform seems to be a reduction of foreign dependence, big corporate dependence, bringing control of food supply into investors' hands. So in my mind, that's a contrarian concept.
Money Shackles is completely built contrarian against the traditional system, right?
Yeah.
And our belief is that the system was built with a code to it, right? And if you're gonna cipher the code, right? I think there's contrarian thinking.
Sure.
And I think there's people with a lot of money and elites, and there's a way the view of money is had, right? And then there's people without a lot of money, and there's a view, and then there's a whole range of people in between, and there's a view of money, and all three have kind of different perspectives of money, and then you micro that down into the individual view of money, and so you get into a lot of different, like you said, personal dynamics when it comes to investing from those different places. And so Money Shackles was built really to work through that code and help people based on their own personal DNA, because you and I can't eat the same food and expect the same results.
Right. I think this contrarian view, I mean, back in the 80s, I was pitching my mobile home parks and I was selling these investors. Those back in the days, that old-fashioned word syndication. Mm-hmm. And there were no LLCs back in those days. They were limited partnerships. I was the general partner. And I was telling these crowds of people, represented by broker-dealers and otherwise, you're investing in obsolescence. They go, my God, what are you talking about? You're investing in an asset that's going to become more obsolete as development encroaches around it. Like where your office is right here, I'm doing manufactured home communities. Can't do one around here. Land value's too high. That, I think, applies to your farming, because you got all this big money coming into farming. You're grabbing up your farms, and there's an economic obsolescence that you're taking advantage of. You look down the road 10, 15, 20 years. That's what we're doing with my ERC Communities company. We're not in downtown Tampa. We're not in West Shore. We're out in Zephyr Hills. You go out to 301 Zephyr Hills now. Hello Lowe's. Hello Home Depot. You see all this stuff happening. And so for me, I think I'm probably repeating. Back in the 80s, 90s, we were acquiring existing properties. We were basically a real estate cash flow annuity company. Now we're a development company, and we're doing value add. We're getting a 250 basis point yield spread on completion of construction. And that's kind of my world is value add. And so it's the same applies with our golf company. Very close cousin to what you're doing. It's very retail. It's very sizzly. But you look at the type of land we need. You look at where we're going in the urban areas with our indoor lounges. You're seeing all this infill coming in, making it a barrier to entry as the years go by. So on an economic basis, I tell investors, look for supply demand. If I were sitting here today pitching some new restaurant concept to compete with Ruth's Chris you have to look at this and say, Jerry, we got enough restaurants. We got all the restaurants we need, for crying out loud. Or a food store chain.
Yeah, but there's a difference between a good restaurant and
a bad
there's
restaurant. no doubt there. That's of course competitive.
I like to eat good.
No, so do I. That's competitive advantage, and that's those are concepts of value proposition. But before we get, that's finance. Over on the economic side is what's supply demand. I'm doing this golf concept. This country could take 400 or 500 of these things in various sizes, and we're nowhere near 100 yet. So that's a supply demand scenario.
I noticed, obviously big competitor, right, with GolfSuites is Topgolf, right?
Sure.
And I noticed a Topgolf near where I live, right? And they're doing so well that they just decided they were going to shut down for 6 months and refurbish.
Yeah.
But anytime a business can just shut down for 6 months and not bat an eye, right?
Sure.
It's pretty damn good industry.
Yeah, that's
it's
Callaway
as
Golf.
Good of an industry as you can be in. Right?
That's Callaway Golf. I mean, they've got a nice deep pocket in there. But speaking of that, you've just walked into a whole other topic when you look at what we're doing with private investors. That's a singly owned Callaway Golf, public company, yes, but ownership of public shares is not fractionalized ownership the way you and I think. It's a totally different thing. You and I are in a very direct relationship, asset to investor linkage, which you don't have there. That's liquid. It's great. Buy it, sell it, do whatever you want. But I'm I have become a real advocate of this crowdfunding concept, this democratization of the venture capital world. Given my background, it's a bit ironic because my basic background was with super highly accredited people, a lot of institutional work. I have 2 9-digit tombstones on my desk, and that's not where we're going anymore. We're on the phone with our investors, as I'm sure you guys are. I saw that at your event. I mean, in the testimonial I wrote, I said I could not believe Dutch. I could not believe the mood of these people. They were acting like they were at their kid's wedding. They were so happy. And I'm not trying to patronize you with a compliment. It's a literal fact. These people were just happy to be there.
But I think that what that is for a lot of people, Jerry, it's a release, right? It's a release because like you and I come from very different money lives, right? I mean, for me, I had to scratch my first investor together as a singular investor, right? Who invested in the first deal with me ever, in my 20s.
Oh, me too. I started that way.
But then getting to accredited, right? Yeah. And going from accredited to institutional, going from institutional to family offices, going to, that super high net worth money, right? I had to come from the underbelly to get to Reg A. I think maybe what you're saying is you started in the underbelly of investing, got to the high net worth investors, and then came back to what we've both found, I think is the code right now is this fractionalized ownership, right? But the investor happiness comes from the pain of money, right? And there's a lot of people that have this pain that's built from a lack of understanding and an anxiety that gets built up, right, in different ways for people. And so to me, that are where when you see them at our conference, what you're going to see is people that have, one, they've made an investment and they've made returns, right? And so if they've made an investment and they've made returns, there's a release of some of those anxieties. I can't tell you how many, working professionals that have a disagreement with a spouse over an investment they made that went wrong.
Sure.
Right? Or an investment they made in a company that didn't actually exist, or an investment they made in a company that did something out of integrity with them, right? Mm-hmm. Or they just simply went and spent a bunch of money to learn about investments and never made an investment ever in their life.
Right.
And so those are all different dynamics I see in those people. And so a lot of them, it's a dopamine release because they're finally in a place where they can be satisfied and out of pain. And I think that's the weirdness of the difference between, like you said, investing and finance. And when it comes to investing is for a lot of people, it's just the reason they just put money with financial advisors and they just hope and pray that the financial advisors are going to do well is because they don't want it. There's so much of not wanting to deal with it themselves. And there's that part of it. And I'm not talking 100% of society, but I do think a good 75 to 80% of society have some real challenges, real pain when it comes to money. Maybe I'm over exaggerating that percent. I don't know. What do you think?
I agree. I don't know the exact percentages. I think there's all kinds of corollaries to this. Fear. There's tremendous fear in this world of finance. And there's also the day trading mentality, the get rich. There's so many things. And now with social media and with TD Ameritrade, and I mean, I go back to when there was no Scott Trade. There was none. You had to walk in and meet a broker and pay these unbelievable commissions. So much of this has changed. But what I think happens here in this notion of fractionalized ownership, what I call this democratization that the Jobs Act really did, is that from a sponsor standpoint, I am dealing with smaller tickets. I got a smaller base of capital now than I've had before, but I got a group of investors who really like what they're doing. My largest investor in the mobile home park business, I had one investor who banked $85 million with me. There was nothing we could ever do, ever, that would garner any appreciation. Mm-hmm. It was all expectation. And those are interesting words that apply to many things in life: marital relationships, personal relationships, business, expectation versus appreciation. And we find now that we have a few thousand of these investors growing steadily, and they just appreciate this. Mm-hmm. And that's a whole new concept for me. I've never dealt with appreciation. I did a business with Alexander Hamilton Life Insurance, Pacific Life, General Electric Capital. There's no sense of appreciation there. It was whatever happened was expected. It doubled your money, doubled your equity on an asset over 4 years. Well, we should have done 2.5. You know, I mean, I'm sure you're familiar with that. So
I was on the phone with an investor yesterday who had made, I want to say he'd made like 26% was the number he had made, right? And he was, you know, really upset. And he's like, you know, I feel like I could, you know, make 35%, you know. and I just said to him, I just said, hey, look, man, if you feel like you can go do that, right? I said, but one, we were blessed to have made the 26% return we made, like crazy blessed, right? And it was just, you know, he invested 50-50 into a deal with us, right? And he made 20, and he said, like, I feel like I go make more on my own. I said, go ahead, right? And to me though, sometimes when people try to get that extra push, right? They try to get those extra percentages, or they go to the deal that's too good to be true, is where they get squeezed a lot of times, and then that's where they get burned. And I find a lot of people, you know, like for us, we've had these really solid returns. But investors will ask me all the time, what's next year going to look like? And I said, the returns will be what they're supposed to be. Don't set an expectation that returns this next year are going to be what they were last year.
Right.
Last year was great, but it doesn't mean that's what the future is.
You can hurt yourself with great performance.
And I try to not set that any expectations with that stuff, because the moment you set them, right, then now you get people that like you said, there's not appreciation, there's not happiness, there's not joy. Right. But it's not just, you can't just make people money. That's something I learned with investors. You have to make them happy too.
Right.
And that's a weird concept to me, because in the beginning I always thought, well, if I just make people money, right, they're going to be happy. But it goes beyond that customer service, beyond that relationship, beyond that dynamic. How do you handle the relationship with, now that you're with thousands of investors versus a few investors?
We've developed, I've done some videos, and I characterize our companies as the old-fashioned corner grocery store, or the old TV show Cheers. I mean, that's a stretch, obviously. I'm being a little facetious.
But Cheers was a good show.
Cheers is a good show, and there's a lot of our life with these investors that's very much this way. Our investor services director, who I moved out here from California.
I don't know that in the modern world, going back and watching Cheers, I don't know how appropriate, like like how much it would be. Like, it's like you could listen to like the song "Baby It's Cold Out There" and how inappropriate that song is.
We have
in the modern world. It's an amazing song.
Yeah.
Pretty inappropriate in the modern world. I wonder. I haven't ever gone back and watched Cheers, but I wonder how many lines they might.
I know they have to be careful there, but I mean, there was a communal. It was a communal notion, and you know, I have to say that I don't particularly contribute a lot to this. I brought someone out from California to do this job, and she does just a great job. And she's like we call her the union rep. You know, she's the investor rep, and we got people calling up talking about high school graduations and bar mitzvahs and weddings and what have you, and nothing to do with the investments. And then 2 weeks later, they come in with their 7th investment or their 8th investment, and so it's very much a family approach, and uncommon, really. I always had great personal relationships. Don't get me wrong. I was doing Reg Ds with a 35 investor count, limited, non-accredited. I think Ellenburg Capital ended up with about 2,800 investors, but that was over 15 years, and you know, a huge portfolio of real estate. So we're smaller now, growing, but you know, the Reg A tickets, as you know, are smaller, and but it's just there's a great personal touch to this, and it's the term I learned. I got it actually from Bob Parsons, you know, the GoDaddy founder who put together a group out in Scottsdale. I can't remember what the name of the company was. They were going to do marketing for us, but they indoctrinated me on this term democratization, which is to really open it all up and to take away the blue chip exclusivity of venture capital. And now these people are getting their cut. I've done some specific designs in my product to try to give choices of different levels of risk. They're my design, preferred stock versus common, dividends versus non-dividends, to kind of give a balance.
But let's define that a little bit for people, right? Tell someone what a preferred stock, like walk through some of those things. I think it's a good education for people, because I think your average person, like you tell them, you're going to invest in a stock, I don't think an average person knows the difference between when they're preferred, non-preferred.
No, yeah, sure.
And if they're not preferred, they feel like they're an asshole, right?
Yeah.
So like it's like which part of the conversation. So kind of walk them through that a little bit. I think people love to learn about that.
I got a little direction on this from my first Reg A facilitator, but looking at both these companies, seeing that there was a bit of a stretch, and comparing to RADD, I think RADD, you turn assets here in various. We do not. We're portfolio built, so this is a long climb with us.
I'd say we're about 80-20. So we're about an 80% hold and a 20%.
Well, then you're okay. That's more like us.
And the reason we like to turn just because we find that there's a healthiness.
Oh,
to
no
the
doubt.
portfolio with a burn, right?
No
with
doubt.
With some
oh,
turnover.
no, because that's
First couple years it was all hold, right?
Yeah.
But then I saw in 22 I saw the interest rates, and I saw some of the hyper appreciation starting to tail end. I thought it was time to start burning some assets that weren't gonna feather as well during this. But then like our land, we have that's not even non-farmland here in Florida, right? I mean, you're talking about stuff that started we bought it at $30,000 an acre right now, and it's $100,000 an acre, and it's like, do you hold it? Do you sell it? What do you?
I know.
What do you do? What do you do with that right now? Because I got 62 acres, right, and I listed it for 6.2 million, and we bought it for 1.2, and I'm like, but we've had people coming to visit it on a regular basis, knowing what the selling price is, and but do I hold that because it's going to be 200,000 an acre? That's the constant conversation.
I mean that's I'm from here. I'm going to one of my law firm offices in Hyde Park, and that attorney there bought 265 acres at 52 in the Parkway before there was a Suncoast Parkway, and still bought it in 82.
I think there's still some land along 52 that might be worth buying.
His wife was going to throw him out of the house for buying it. Now she very much keeps him in the house for having bought that land. Back on my point, what I do when I'm giving webinars, I always refer people to Google. That's my new word. I said, folks, Google this term. Google preferred stock. Understand what first money out means. Google convertible preferred stock. I decided to offer investors a backstop, in that if they were coming in such early stage, and both my companies are still what you'd call early stage, that in any monetization event, any sale, merger, IPO, whatever it may be, they'd get the greater of what their what their share position ownership would be, or the amount they invested. That's what preferred stock is. It's first money out. We offered dividend, which at the beginning we had to self-fund. Now cash flows fund it, but the dividends, because you're familiar with the tax laws and depreciation, the dividends are like tax deferred for years. So that and so that they feel very good about that. It gets a tremendous investor repeat. But I think that's what worked for us. I wanted to make sure the investors had a kind of some form of a priority position, and as you know, Dutch, that's what preferred stock does. It's a priority position that they have over common shares that I and other founders own. So it's very fundamental in our design. We also offer common, and when I'm selling common, if I get on the communication, say, listen, you're getting it at a much lower valuation, you're getting a much better share price, but you're in play. You're in play right there with me, and you don't have the preferred set. That's right, and so you get interesting combinations.
So I think with preferred, I think first paid. I think common. I think you're into the end, right? Those are some of the common conversations,
right?
For sure,
right. We're offering combination now, and interestingly enough, it's just different strokes for different folks. The wealthy our investors are, the big ticket buyers. The minute I came out with common, they're flipping right over. They want that extra. That's human spirit. So.
Yeah, I think when you find capital, that wealthier investors, I think for them the biggest thing is one, safety, but also what's the biggest part of the play? What's the biggest part of the gain within? I think all investors want safety, right? But I think the common investor, right, has a little bit more at stake in the sense of what they need from a return standpoint, right? They have to push, to get a certain amount of return, otherwise they're not going to be able to retire. They have to get a certain amount of return, otherwise they're never going to get free, right? And so they're, I think, more likely to make mistakes sometimes because they're not purely coming at everything from a safety first standpoint. Sometimes they come at it from a what's my return first, and then what's my safety first. And I think for me personally as an investor, I got to know what the worst case scenario is. I don't know if that's safety first, but I got to know what is the worst possible thing, no matter what happens with this investment, right? What's the worst possible scenario here? And if the worst possible scenario is I get my money back, if the worst possible scenario is I make money, right? Then I'm feeling pretty good when there's an upside, when there's a potential upside. And whereas I think a common investor looks at a lot of things, if they see a 30% or a 40% or a 50%, right, kind of potential in the future, then that's where they get hooked. And that hook is dangerous because anytime somebody's quoting crazy high returns in the future, the risk has to constantly be going up. The potential risk has to be skyrocketing because otherwise you can't be quoting, those kind of things. So it's interesting how an individual investor looks at deals. Now with ERC, is that more of a fractionalized real estate ownership, whereas GolfSuites is more of a seed business investment and real estate at the same time? Or kind of feel because I'm not all the way in to those offerings.
No,
yet,
sure,
right?
sure.
So I'm just more of a curious because we're pure, right? We're pure fractionalized real estate, right?
Right.
There's not much of a business investment for people. It's pure real estate. So.
Well, we've probably merged that. Both of these are C corporations.
That's what it sounds like.
These are C corporations where you're buying shares.
Yeah.
We also offer joint venture opportunities, and we do a big business. That's my old world. So we have joint venture work. We have bridging work. We do kind of.
So with your joint venture, are you doing like GPLP, or are you just doing 50-50?
No, we're doing a shared. We did 2 of these in the golf company so far, and we've got offerings out now on our 4th golf site, and where. Interesting, someone comes in and buys some shares and does a little sample, and they find out we're doing this. We have a very fixed program on JV where we share capital 75-25. So you take $1 million of equity. Investor comes in $750, we come in $250, and then we share all the upside 50-50, and we do an 8% pref, an 8% first money out pref cap. I always give a pref. It goes way back to the 80s when I first started syndicating. I've always felt that way, that we're getting fees and we're getting our upside. We're obviously leveraging our equity. So we do preferred stock, we do common stock, and we do joint venture. The joint venture is larger ticket. I have to get involved in that, run that through. But your question about real estate, ERC Communities is just a very traditional, very mundane real estate play. We buy land, we horizontally develop it, we bring in brand new 1,400 square foot manufactured homes, and we rent them out. That's all starting in Zephyr Hills now on 4 different parcels, 265 units. It's about a $53 million funding, which will end up being about 14 million of equity and probably 39 million of debt, wrapping up the debt right now, and in 4 different parcels staged. That product there, Dutch, is that's my bailiwick. That's my oxygen. And I, my junior partner in this, our company president, Ryan Koenig, has about 2/3 of $1 billion in construction completions on his resume. He's done high-rise, mid-rise, hospital, apartment, hotel, condo, everything. He does this without even getting out of bed. This is intellectually very simple, and we'll splash this out nationwide. I mean, we really think this gets to 4,000 or 5,000 rental units, and we are either a REIT conversion, an NYSE REIT, or a REIT merger. The golf company has a lot of real estate component to it. Again, a C corporation, buying shares, or you're coming in JV. JV is the same concept. We lease facilities. We own facilities. Our 4th site, we're starting now at Auburn University. We'll own it all. We own Lubbock. We lease Baton Rouge. We lease Tulsa. We think we're coming into downtown St. Petersburg with our first indoor lounge. We're going big into the indoor business, and that would be a lease. So we wake up with 30 locations one of these days. It's probably half owned, half leased. So you have a real estate play in there. ERC is just 100% real estate. Real estate's kind of where that's the basic oxygen I breathe. On the golf side of the business, I have extremely talented people. The man who took Top Golf from 5 to 38 locations is our COO now. He ran the Romano's Macaroni Grill before that for 18 years, 100 locations. So he's a food and beverage maniac, and he basically co-invented this whole Top Golf arena. So very well managed there. So in all honesty, I'm a little more dependent on that management team there, but they do a great job. Whereas ERC is really my
I mean, management team is important. It's like for us, with Dustin Warren running our farms, having been a generational farmer and having taken, the education and knowledge to the highest levels when it came to agriculture and farming and being able to look at a farm. It's like a composer, like a Da Vinci, kind of person when it comes to looking at a farm. You have to have those people a part of your management team when you're running, specific types of projects. With your ERC communities, so from a standpoint of, so you go acquire the land first, right?
Right.
And so is that you're pretty much acquiring land with cash, or are you financing the land originally?
It depends. We have lending sources. We have bridging sources who I've known for years. This law firm over in Tampa loves financing our stuff, and then we pay it off as we sell shares and bring in our institutional financing. Now is each community, or you're doing a singular offering, or are you doing a Reg A where you're doing multiple communities under the same Reg A? Well, under Reg, you have a corporation that sells shares under Reg A and Reg D, and it's the principal owner of whatever we do. That entity, in turn, will JV with a private investor. We've got a group looking right now at doing 2 of the 4 communities that we're doing in Zephyr Hills. We have 4 different parcels, so I can take a JV investor for all of it. I can take for part. And that's very quick study for me. That's very simple design, extremely. We have multiple papers out on that. And what'll end up happening in Zephyr Hills, we may end up having a joint venture partner in there. We may not. It just depends. We'll obviously grow the company faster to the degree I bring in JV. And again, that's pretty much my forte. Right now, the golf company has a doctor, a very wealthy doctor out of Kansas, who came in with just under a couple $1 million himself to JV a couple of our golf facilities. And we have a group of NFL players here in town that are looking at coming into the Auburn site. And so we do it or we don't do it. The shareholders in Reg A get quite some benefit from joint venture because we're leveraging equity. We're getting 50% of the gain.
You win from scale.
Win from scale.
Venture,
absolutely. And of course. And I'm sure you get hit with this too. I mean, American investors, I'm going to be a little sarcastic, but many American investors want their money out before they even put it in. I mean, know that. What's the exit? The magic word is always exit. The European model isn't like that. The European investor is a multi-decade thinker. And the greatest wealth I've seen, you follow people like Warren Buffett, my mobile home park partner.
Always for the long game.
Yeah, my mobile home park partner out in Los Angeles, he and I own about 6,000 rental units together. He himself owns another 24,000 rental units, 22,000 of which are free and clear of debt. And he owns an apartment building that he bought in 1960, if you can believe that.
I mean, that's one of the power of real estate, though, is over the years it compounds in a way that is hard for people to comprehend, right?
Yeah.
And if it's not compounding, it's not worth doing it, right? When it comes to real estate.
Yeah. The old rule: you don't wait to do real estate; you do real estate and wait.
Yeah.
And
there's occasionally markets where you can get in and out within a
no
year
doubt
within real estate,
no
and
doubt.
there can be money with it. But traditionally, that's also where people get caught. Because they had set an expectation where they're going to be in and out in a year, and then the market shifts. Suddenly, interest rates go up. You have an '08 crash. You have other things that happen, and that's where people get caught. And lots of times, where it makes sense to be in and out in a year is more towards the back end of a market cycle, is what I found. Right? It's like 21 was a great time where you can maybe be in, but halfway into 21 into 22, maybe you could be in and out in a year. But you're also taking a lot of risk in that moment because you and I knew for sure that we were backing up into interest rates going up. We knew we were at the tail end of hyperinflation. And that, if you're not in that moment, if you're not buying for the long run, that's where people get caught. And obviously as investors, nobody wants to get caught.
Yeah. Well, of course, we're all going to remember the first half of 22.
Yeah.
I emptied out the rest of my Tampa inventory of my home building business. I mean, what we saw in the first half of 2022, and I've been doing this a long time. I mean, it was just crazy. And I thought to even in the neighborhood I live in, I live right on the Gulf of Mexico up north of here, and we saw houses in our neighborhood just going, what's going on here? And we just saw them, settle back down a little bit. So that's going to happen, here and there. And it's interesting.
But I do think here in Florida, man, I will tell you, I think next summer, because of the elections, I think we'll see migration, we'll see population moves again. And I think we're going to see pretty crazy prices.
Oh, sure.
You know,
are you a
but
California
I don't think
native?
nationally. I'm a California native.
So am I. So, this is becoming the next
But
California.
I am very glad, though, that I got out of my real estate and out of a lot of things out of California before the new taxes they did. I don't know if you've heard, but,
no.
if and forgive me, I might be wrong, and the team might be able to do the exact research, but if you, sell a home worth more than $1 million, an extra 5% tax. If it's more than $10 million, it's like an extra 10% tax.
Oh, my God.
And, you're talking about, that's a pretty huge tax when you're talking about a $10 million sale and you're talking $1 million of it is gone, right? Pretty quick. But, it's California, so it's like its own planet. And I lived in that planet for a long time.
Yeah.
But what I saw was, I couldn't see myself raising my children in Los Angeles. And I know there's people who love Los Angeles. And I'm, I loved California for a long time. But the challenge I'd walk into is in one experience, I took my sons, right? We were downtown, Los Angeles. And I'm trying to remember. It's so funny. I don't even remember what we were doing that day because of what else was happening with the experience. And it was, one of the festivals or fairs or something, right? And it's in one day, my and I'm talking, I have 6 and 7 year olds, so they were probably 4 and 5 at the time.
Yeah.
And one day, my sons, for the first time, saw people shooting up, right? And I'm not talking about Skid Row. I'm not talking about.
Right.
I wasn't going to take my sons down to Skid Row, right?
Sure.
I mean, I might take them down to see it to a certain extent, to learn about it, but I think a little bit older would be better for that. But in one day, they saw somebody shooting up, right? They saw a naked man laying on the street that literally you had to step over to watch. And I'm talking about business district downtown. And then I remember my son Tony literally saying, "Why does everything smell like pee?" Right? And I'm just thinking to myself, that to me, I was just in a place where I couldn't, that feeling of it's weird because we're in a world today where here in Florida we don't really understand that COVID exists, right? I know that it exists, right? And I know that there's people. It's at in DC, the national champions are having, if they're non-vaccinated, they have to wear a mask and social distance, right? And I'm not going to give an opinion about vax versus non-vax right now, but I'm just saying more here in Florida, you don't realize that it's still a thing. We live our day-to-day lives and you don't hear about it. But in my California office, right, I will hear about somebody catching COVID. I'll hear about people testing, and here you wouldn't naturally think of even being tested for it. There is some different universes that exist, and it's fascinating. And it doesn't matter even whether you're left or right. It's a different kind of universe that exists there versus existing here, which I find fascinating because I'm still there a decent amount. But it is different.
Listen, I migrated out of there a long time ago, and went up to Oregon first for 6 years, then moved out here because we had all these properties out here. But I was moaning about California in the late 80s and go back there. It's just, but people say, where are you going to do all this? Where are you going to do your GolfSuites? Where are you going to do ERC communities? It's all going to be from the 3 o'clock to 6 o'clock part of the American map, southeast, south of the Mason-Dixon line, Texas and west. That's pretty much right. And these towns are popping up, Dutch. Towns like Little Rock and Birmingham and Jackson. I mean, unbelievable growth. Florida, people are leaving Florida now because of affordability.
It's the migration.
Yeah,
right?
It's the migration.
And I think that's an important real estate. Location never stops being one of the most common success versus non-success stories in it. And so if you don't pay attention to population migration right now, you're not trying to be successful in real estate. For me, people have always been asking me, well, what's the next market? I said, well, for us, between Houston, Tampa, Philly, and what we do in Southern California, I've always been I don't think we need another market.
Yeah.
But I'm looking at some of these communities, South Carolina, North Carolina, Alabama, Arkansas. I'm looking at some different places where instead of moving to Florida where prices have really gone up and it takes more affluence, people are moving here, right? It's fascinating that there's these other cities that people are doing virtual, but it's not just West Coast. There's stuff not just East Coast. There's stuff on the West Coast where if you're paying attention to the migrations, there's these pockets in these cities that are building up. And it's fascinating, where I grew up in Des Moines, Iowa, right? There's a city that was, I want to say Waukee, right? Mm-hmm. Was when I grew up, it was literally like a thimble. I don't know what the population was, 5,000 people, 10,000 people. And now it's a rival city to Des Moines, right? It's kind of like Dallas and what's the city outside of Dallas where they're Fort Worth?
Fort Worth,
Yeah, like
sure.
they're really two major cities,
Yeah.
two of the largest cities in America, but they're really one geographic metropolitan. It's weird. I love that dynamic of analyzing here in the U.S. And it's always also where are developers like you wanting to build, right? If the developers like you are wanting to build in Zephyr, I'm like, well, that means there's going to be other good potential opportunities in that area too.
My Zephyr Hills project, about a year ago, we went into Pasco County Community Development Office. They wanted to joint venture with us on individual parcels of land, which we can't do. We're sitting here talking, and the commercial there's these different managers, and I'm not into this stuff too much. I don't really know how the counties work, but this guy says to me at the end of the meeting, "When are you going to start renting?" I said, "Well, tail end of 23 probably," which at that point was like a year later, or a year and a half. He says, "Will you call me?" And I said, "Well, sure. Why?" He goes, "Well, I mean, how many units are you doing?" I said, "We're going to do them in phases, but over an 18-month period, we'll deliver 260, 265 rental units on these 4 sites." He goes, "Okay." He said, I can put that out to about 1,000 people, and you'll probably have 100 rental applications." And I sat up in my chair. What? He goes, "Jerry, we are turning away business in Pasco County." I'm not talking Hillsborough, Pinellas now. I'm talking Pasco County. We're turning business away for backroom operations, warehouse operations, average median salary, $90,000 a year, incoming jobs. We're telling them, you can't, they're saying, "Do you have housing?" "No, we don't." "You have anything projected?" "Not enough." "Okay, we're going to go to Hernando. We're going to go to Citrus. We're going to go to other counties." He goes, "Help us out, Jerry. Get built." Mm-hmm. Can you believe that? This isn't downtown Tampa. This is Pasco County, Spring Hill, Newport Richey, Dade City, where we are in Zephyr Hills.
Well, you're going to run into the housing crisis, right? Yeah. And the housing crisis isn't a price crisis. It's a shortage.
It's a supply
crisis.
Yeah, right.
And you're going to run into that throughout the country. Anybody who wants to build a city, grows a city, wants to, find individuals like you and I, right? And get a strategic plan for adding housing to their city. And any city that wants to, I was on the phone on a podcast interview with Tudor Dixon, and she had ran for governor of Michigan. Mm-hmm. And she was like, "Dutch, were you planning on investing in Michigan?" And in my mind at first, I'm like, hell no, I'm not planning on investing in Michigan. But then on the second thought, I'm like, well, what are you guys willing to do? Sure. Right? How are you willing to make this work? How are you willing to be a partner, right? Because reality is governments and private business can work hand in hand together, right?
Sure.
To go and make things successful. And I say private business, I mean it can be a public business, but businesses and government can work together to make communities a reality.
Sure.
And if Disney wouldn't exist if the state of Florida hadn't opened the doors the way they opened the doors to Disney, right? And many other great businesses in America wouldn't exist the way they do if the cities and the counties hadn't been an enabling force. I don't know how often that happens, right? We have cities like Philly, where we have 300-400 units, and it's like, how much communication is the city trying to enable us, right, to improve the condition of that city? Not really. If they did, we'd probably be at 600 or 800 units.
I see.
And you start taking a look at what's the ease of the process? Is there land banks? Like a lot of cities have land banks where they have land available for construction, land available for developer. But is there tax benefits? Because for you and I, an extra 5%, an extra 3%, right, on a construction project or a real estate project makes all the difference.
Make or break.
And the difference. And in Philly, one of the things that we've done is in neighborhood after neighborhood is just boarded up homes. Just getting rid of them, right? Either tearing them down and building up or refurbishing, remodeling, those type of properties. And it's made a huge difference in that city. Now in here, we're mostly in luxury real estate, right? And so it's just kind of difference in where is the correct pocket. But I think if you worked with government, with the housing crisis, it makes a huge difference.
Yeah, we're going through that right now in St. Petersburg, whether we get this exact site or not. But it's a historic, and the city wants to do all these things, but they're handcuffed.
So does the city own the property? Or
no, it's privately owned, but it's a historic landmark that's just a terrible white elephant. Yeah. It's just unreachable by most people. We want to do a higher end simulator lounge in there, and we've already met with. When I say we, my architect and my partner, they're talking about it, and they're just so excited. Mm-hmm. But historic this, historic that. You can, you can't. The building sat empty for 7 years.
Yeah,
just sits in the middle of downtown. It's terrible, So we're working through that kind of stuff. But the government stuff can be extremely incentivize business. But we are sitting here. You and I are sitting in the epicenter of what we think probably is the key American population growth curve over the next decade. As that population grows in the urban cores, you probably know the political spectrum moves left. It gradually moves left. We're going to have to be ready for that. That's okay. I mean, I think the core of America lives, in my political opinion, between 11 o'clock and 1 o'clock. Mm-hmm. It's not Bernie Sanders over at 9 o'clock or some radical Republican over at 3 o'clock. I think we live in there is where we are. That's where we want things to be. But I'll tell you, I'm excited about the southeastern United States. I'm excited. I'm excited about towns I never would have thought of before. Never even thought of before. And so we're going to push this residential program hard. We'll push them both hard.
Yeah, with our farmland, like in Idaho, right? I would have said for years. I was telling Dusty no, and he was on me. He's like, I think Boise's an amazing city. I think there's all these different cities around Boise. No,
I know Boise well.
Cities. And he's
sure.
like, you would invest here, and I was like, Dusty, I'm not going to Idaho to invest, right? And I said, I'm a Californian. I said, I'm already in Houston and Philly, right? And this was, years ago before we were even in Tampa.
Yeah.
And I said, I'm not going to Idaho to invest. And he's like Dutch. And it's kind of like one of those moments where, somebody thumps you on the forehead. And it's funny because I'm the guy who owns, hundreds of units, and Dusty's really wanting, me to invest in Boise as a close friend, right?
Yeah.
And then I opened my eyes and I said, man, look at all of these towns, look at all of these cities, look at all of these different components around Idaho that are in the wave, right, of development, in the wave of construction. And I say, those waves are huge in the right cities where people want to live with different views and different beliefs, and people are moving virtually. And then that expanded into our first farm. And for me, I never would have thought that farming was going to be an answer, right, to the future of what we were doing. And I started looking at each farm unit as a housing unit, each farm unit as an apartment, each farm unit as an income-producing unit. And as I started to look at those, each acre, I started saying, man, now, where else am I going to get 7,500, right, units? And that's where we're at with acreage, 7,500 acres. And at a share, at a purchase price of $3,000, $1,500,
sure.
$4,000 an acre. And as you expand, you have to look at these areas and markets that, for me, we buy our farms to be farms. But it doesn't mean I'm perfectly happy to be in a corridor between two cities.
Oh, sure.
I'm
glad you brought that up. Yeah, alternative use.
Yeah.
Sure. Higher and better use.
It's that potential upside in the future,
sure.
right? I think our Weiser farms are some of the most beautiful farms in the world, and they're going to produce income. And, they've grown from, a couple thousand an acre to 10,000 an acre over the years. And that's exciting to me. But what's also exciting for my investors is, hey, if it's between the corridors and it suddenly jumps to 30,000 an acre, if it's in the corridors and it suddenly jumps to 100,000 an acre, I'm okay with that too. I'm okay with my 2,700 acres turning into $270 million.
Yeah, right.
I will go buy a lot of amazing farmland.
Yeah, right.
For $270 million.
That's true, you will.
But for us, it's all about how do we continue to find the best next venture for our investors, right? And for you guys, it sounds like with GolfSuites, it sounds like you have a wave of opportunity that it's just you're going to continue to stack up the stairs over the next decade. Do you feel like GolfSuites will have 100 different locations in 10 years?
I can't represent 100. I can see because I get asked about exit. I get asked about, and in all honesty, people ask about exit.
Do you think Topgolf will come buy you guys out at some point?
I don't think so. I don't think so. I think that someone else would be higher incentivized. I think, there's all kinds of companies that could have interests. If you look at the Callaway Topgolf relationship, we have a close relationship with Cleveland Golf. But there's TaylorMade, there's Cobra, there's Titleist, there's all these different companies. People people ask, would you IPO it? I've been involved in one IPO in my life. I don't know that I would take my shareholders into an IPO in the golf company. What I tell them when asked on webinar, and I get asked all the time, exit.
They always want to know. They always want to know.
I say that the ideal transition, the ideal time is to have good, stable revenue and profits and be on a good hurdle. You don't want to sell on this kind of a hurdle. You want to sell on kind of that kind of a hurdle. So we wake up one day with 40 locations operating and we've got 12 developing. That's a nice hurdle. Someone may come along. Ideally, it's a large public company. And as you know, Dutch, you can exchange your shares tax deferred, tax free for shares of the public company and sell them off at will. That's a big generation skip.
I think people who don't even know what the word tax deferred means.
Oh, I try to explain. I do my
Mr. CPA.
Well, that's what.
Retired.
No, I take you into the weeds way too soon. I lose you at the introduction. So I got to watch myself on these. But the bottom line is, especially when you look at generation skip, you get a 70-year-old investor in there who has a big investment. You have the step up in basis, complete elimination of capital gains. It's phenomenal. And so I see the golf company doing a merger with a major public company. That could be a Revlon, it could be a Brunswick, it could be whoever. Revlon, the Revlon makeup company, Ronald Perlman owns Coleman camp stoves and Mastercraft boats. I mean, go figure that out. So, he's a micro Berkshire Hathaway. ERC Communities, that's a whole different story. That could IPO as a New York Stock Exchange REIT. And it just depends on how fast.
Now, our friend, Galliano, from Boxable, he would write ERC Communities to start putting Boxables.
Yeah, we saw him, by the way, at dinner at the Sunday night. We were at that, I can't remember what it's called, just right off the hotel property. We saw him there, and we visited for a while. We were having drinks and a meal. Lovely guy. Funny guy. What a concept. What's his? Is he going to do a house a minute or something? What's his?
He wants to get to a house a minute. Yeah.
The Henry Ford of housing.
60 houses an hour.
Yeah.
That's what he'd like to get.
Wow,
to,
that's
right?
great. That's great.
Yeah, that's a lot of employees.
Oof.
I think one of the things I've grown is I love our team and I love our people. I don't know that I ever want to deal with thousands of employees. It's just the gambit of that is just such an undertaking. And I'm such a person that like customer service, like loyalty, satisfaction, happy is such a important part of the journey to me. And keeping that many people satisfied, right, is challenging. Yeah. And
how many now? What's your staff count now?
Between all the different companies,
yeah,
and the different resources, about 150.
Yeah, well, that's a lot. That's a lot of people.
I work my ass off to keep them happy but balance between happy and performance.
Yeah.
Right. It's not just to keep them happy so that people can just live life. It's happy because I want the best for them so that we can get the best for our business. Yeah, we do a ton of cultural things, with our team and our people, and we have scholarship programs for all of our employees, their kids, their spouses. And them themselves, right? I don't know how many employees that are going to some type of college education, some type of continued, journey. And sometimes it's not even directly related to their future with RADD. But my realization is them living their passion and their dream just creates performance. And I feel like there's a unique balance. My oldest employees are over a decade with me now at this point. And that's interesting too, because then you have veterans that have to commingle with brand new people with ideas and concepts, and you have people that have, are doing certain ways. So marrying them together and figuring out how you synergize, right? And how does a veteran of 6, 7, 8 years now have a boss, right, who's been with us a year or 2 years, right? and like recently, CFOs, we brought in a new CFO earlier this year, and our old CFO is still part of the company, right? And they work really well together. But marrying those two guys together, right, was a venture, because one CFO had to surrender ego and say, hey, there's somebody who's done REIT, somebody who's done public market, somebody who's done this higher level of accounting, whereas the one CFO is a great accountant and he's done good stuff for us, but there was no way, and he doesn't like to manage people either. So, now we're at 9 accountants, so it changes the game. I never, thought I'd be at 9 accountants, this quickly, but, I would probably still need more accountants. So,
yeah, we have, people laugh when I tell them this, but you give me a $100 million revenue at the golf company. and that would be probably 3,000 employees.
Mm-hmm.
You give me a $100 million revenue at ERC Communities, would be about 25.
Yeah. It's a difference.
So you see the look on my face. I mean, so it's just it's a complete cultural divide in terms of, allocation of duties.
It's interesting because on our real estate side, I would say we're less than 50 employees.
Yeah.
And I would say on our education side, we're probably 100.
Yeah.
And our real estate side, is because, we're managing so much acquisition. And, because we're managing, we're buying 30 to 40, new assets a month. And when you're doing that many acquisitions, there's the individual acquisition guys, there's the loan team and different things. But if we weren't turning that kind of machine, it wouldn't be necessary even to have 50 within the real estate machine. But we turn a lot of assets, for us. And so that's where the size of that is. But I'm also feeling like we're going to, be investing a lot more money every month. So I love that part of it. So
no, that's great.
I mean, I'm like a capital addict, right? The more money I have, the more real estate I can go buy. And so like there was a breakthrough for me at one point, and I think this is for a lot of real estate investors that are wanting to live or have full-time real estate. And it's probably a breakthrough for a lot of them is the day that you learned that, yes, you always have to do good real estate, but the purpose of doing good real estate is to acquire more capital. And the purpose of more capital is to buy more real estate, which then acquires more capital. And like that whole circle.
It's the cat chasing its tail.
Yeah. And so for me, like the day I broke through and I said, today I bought a piece of real estate. And in this piece of real estate, maybe I spent, let's say $500K.
Right.
And I bought this piece of real estate today, it's going to be worth $750. So today I acquired $250,000 in capital.
Yeah,
so
right.
every time I look at a piece of real estate, how do I acquire capital within that specific deal and structure? And so that's how I always look at real estate. And that's when I flipped from just doing deals and only wanting to do deals and myself and going to investors and bringing investors in with us.
But it's captive.
Yeah. But also they came to me from the education side and we're always saying, put your money where your mouth is, right? Some people teach and they don't do. Some people do and they don't teach, right? Yeah. And we were teaching, but not doing with them and just doing on our own. And then in 2015, they were on me and they were like, always like, put your money where your mouth is. Do it with us. Do it with us.
That's very cool. I didn't know that history. That's quite a history.
And I said, sure.
Wow.
So let's do it together. So I've only been bringing investors in since 2000. 8 years seems like a long time now.
It's like 5 minutes.
Yeah. But it's quick.
Yeah. Wow.
It's a blink and it's forever all at the same time.
I didn't know you came in from the educational side. That's that's pretty cool actually. And then your students wanted to team up with the professor and that's great. That's great. I'm more do than teach, but I'm all do.
I'm gonna get you on more podcasts with us. Okay. You are doing a lot of great teaching today, right? I think these communities. I think people want to be a part of a crisis, right? And the housing crisis in America is real, right?
Yeah.
And I think ERC Communities is definitely some people are going to want to learn about it. They're going to hear about it, right? And I think it's it's a great story for you to be able to tell, and I love sharing it. So we're a wrap, right?
That's
today,
great,
but
well,
you shared great nuggets. Aaron told me how to sit properly in the middle of the meeting, which is one of her roles. But I'm just teasing.
You're well. I've noticed at the seminar in here, you're well guarded, well protected.
I am.
It's very cool.
I am.
Very cool.
They help me keep my.
Well, thanks for having me, Matt. It's an honor to be here. Seriously.
So let's go take a tour and then we'll go eat.
Yeah, good.